Our top story tonight, record earnings from two of the nation's biggest banks, but stocks on Wall Street ended their winning streak. JPMorgan and Wells Fargo reported big profits, but investors were not impressed, focusing instead on a decline in their mortgage business. The worry is that weak loan demand could jeopardize the U.S. recovery. Looking at those quarterly results now, JPMorgan's earnings jumped more than 30% to $1.59 a share, 20 cents more than analyst estimates. That's thanks to gains in investment banking, not loan growth. Revenues fell 3% to $25.8 billion. That was slightly below expectations. And a similar story at Wells Fargo, where profits soared 22%, 92 cents a share, beating estimates by 4 cents a share. Revenues, however, fell 1.6% below expectations. Joining us now with more analysis on all of this, Fred Cannon. He's director of the bank research firm Keefe, Bruyette and Woods. Fred, what is the most important takeaway from these reports today from JPMorgan and Wells Fargo?
The most important takeaway is that at these big banks, revenue growth is very hard to find. It seems like every time something kind of goes right, something else is going wrong. As you said, the trading income was strong, mortgage income under pressure. So to get these record earnings, what they have to do is they have to have great credit, that is, everybody's paying back their loans, and also keep expenses under control. So they continue to post good numbers.
Everybody was focused on what was going on the mortgage side of their business. Mortgage loans and applications were down. And yet we know that home prices and home sales are up. So it seems like there's a little bit of disconnect. You would have expected more loan growth.
One would expect, but remember, it's all about refinances today. And what happened last year was not only did we have record refinances because of very low rates, interest rates, and the federal government's programs to help people refi, but we also had very few mortgage banks lending last year, and so the spreads in the business were huge. Well, what's happened now is there's a bit fewer loans, but really what's happening is the competition for them is so tough by the banks now because of the profits. Those spreads are coming in, and that's really what's pressuring the earnings right now.
All right, so today was all about JPMorgan and Wells Fargo. On Monday, it is Citigroup, and then on Wednesday, Bank of America. Are we going to be hearing the same story, the same themes from those banks?
You bet. These two really set the themes because they're the two bellwether stocks. And so next week we're going to hear good trading, pretty good investment banking, but boy, that domestic revenue's under pressure, spreads are down, mortgage banking's down.
Looking at the recommendations, the bank stocks that you are recommending right now, you've got Citi and Wells Fargo. Let's start with Citi. You know, investors have had to be patient for a really long time. How much longer do they have to wait if you buy the stock at $44 a share?
Well, I think that you still have to be patient. This is a long-term turnaround. It's probably the biggest restructuring story in U.S. financial history, perhaps, and maybe in the whole U.S. economy. But we do think they're going to continue to post good progress on that restructuring, number one. Number two, this mortgage banking really isn't a big revenue item for Citi. They're not doing that much. But the backdrop you mentioned is increasing home prices really helps clean up some of the legacy problems there.
Tell us your thinking with Wells Fargo. That's the other one you're recommending at $37. It was down today. But long term, you think it's a good buy?
Right. Long term, I mean, you know, everybody's worried about these short-term mortgage banking numbers, as you talked about. That was like 19 out of the 20 questions on the Wells Fargo call was about it. But if you think about it in the bigger picture, rising home prices, and we're seeing a strong market this spring, are a very good thing for banks. It means the assets are better, it means credit quality is better, and at the end of the day, higher home prices means people are going to be borrowing more money.
We have a few seconds left. Bank stocks have been rallying actually since December. Is this the end of that rally, or is there still some upside overall?
I think that home prices is a very good backdrop for it. But remember, the other problem is the 10-year yield curve, the 10-year bond yield has come down. That's a little bit tough for the banks in the short term. But over the next year, we think there'll still be some background because of those home prices.
Fred, any disclosures? Do you own any of these stocks?
I don't. Right.
Okay. All right. We'll leave it there. Have a great weekend. Thanks so much, Fred. Fred
Thanks,
Cannon,
Susie. Great to be on.
Director of Research at Keefe, Bruyette and Woods.